Hello everyone, it's Christy here, and in this video we are going to be talking about mortgages. Yay! Possibly the least sexy word in the English language, but don't worry, it's going to be fun. Don't go anywhere. This is going to be good. Same spirit as the other videos that I've been making. This is going to be for absolute beginners, and maybe not even absolute beginners, because I had a mortgage for quite a long time before I actually really understood how it worked. So maybe this video is for you, if that's you, or if you're thinking about buying or building a house, then this is for you. This is going to be focused on mortgages in Australia because that's the experience that I have, and same with the other videos. I'm not a financial advisor. This is just based on my experiences and the research that I've done and the things that I wish I had learnt long before I learned them. So I made some notes as well. So yeah, we'll start with the word mortgage because it's pretty funny how that term came to be. It's a French word that was used by English lawyers like back in the day, and it pretty much meant an engagement until death. So there you go. And it didn't mean like the death of the person, but it meant the death of the engagement, which was the agreement. So until it was paid out. That's not how we use it these days, but I just thought that was a fun little fact that I wanted to throw in the video here. So in 2020, what we're referring to when we say mortgage is basically you want to buy a house and you don't have all the money to buy it. And so a lender, typically a bank, will lend you that money and want to get paid back across a term, which is typically 25 to 30 years. Mason is over there playing, so apologies if you hear all of that. But yeah, over a term, so a period of time, which is between 25 and 30 years, but you have to also pay it back with interest, which is pretty much fees for the convenience of the lender giving you the money in the first place. So that's what a mortgage is. They hold the property that you're borrowing the money for. They hold the rights over it until you've paid off your mortgage. So basically, if you don't pay your mortgage, they can come and take that property to recoup the rest of what you owed them and keep it. Like, yeah, it's hopefully that never happens. Hopefully that's not something you ever have to experience, but that's pretty much how it works. You want to buy a property, you want to build a house or buy a house, and you don't have the money. So you lend the money and you have to pay that money back with interest, which is extra money. Plus they have pretty much ownership over that property until you finish paying it off. That is what a mortgage is. But how does it work really? And can you do anything to help yourself in the situation of being the repayer? So the answer is yes. And banks and lenders don't really ever tell you about these things because it doesn't serve their interest to have you pay back your mortgage faster. They make a lot of money off of mortgages. They make, if you borrow that $450,000, depending on your interest rate, you can pretty much be paying back $450,000 on top of the original amount. So that brings me to principal and interest. These were terms that I just did not really understand very well until, I looked into it and got my head around it. So principal is the original amount that you need to borrow. For example, I'm going to stick with the $450,000 amount. So $450,000 is what you need to build or buy this property. That is the principal amount. The interest is the extra fees, the extra money that you pay across the life of the mortgage, otherwise known as home loan. So yeah, home loan, mortgage, same thing. But the interest is a percentage amount calculated on the principal. So if you only needed $100,000 and your interest rate percentage is 5%, it's going to be calculated 5% of that 100,000 every year or annually. But if your interest rate is 4%, so it's a bit lower, which is what you want it going that way, not the other way, then you will pay less interest on that 100,000. I hope that makes sense. I think so. So the interest rate, so the interest rate can be fixed or it can be variable. Now, if you fix your interest rate, which is what banks like you to do because it means that they lock you into paying a certain amount of interest, the interest rate can vary and go up and down depending on the economic times that we're in. So for example, COVID means that the interest rates have gone down. So if you had fixed your interest rate at 4%, then now they've gone lower than that. You can't move your interest rate around, which is a bad thing if the interest rates are going down, but it is a good thing if the interest rates go up. So that's a decision that each person needs to make based on their individual circumstance and how you feel about the economy. This was just more, I wanted to explain what the difference was between fixing it and leaving it variable. Variable means that your interest rate will change from time to time depending on the economy. So yeah, it can go either way. Sometimes they will say, do you want to fix part of your mortgage? So out of your $450,000 principal amount, do you want to fix half of that? So $225,000. You could fix it to have 4% and then let the rest, the other $225,000, go up and down and be variable. That is an option. So yeah, that's just what that is and how that works. Another thing to look out for is the other fees that are often in the fine print of the mortgage documents. But I mean, they do tell you about them at the start, but I think, again, you've kind of got the blinders on when you're so excited about getting this new property that you don't really worry about them too much at the start, but they can be costing you a lot over the long run if you don't pay attention to them. So things like a monthly account keeping fee on your mortgage, it might be $20, might be more, might be nothing, but yeah, have a look if you've got that and why you've got that. Other things like an annual rocket repay booster fee, like just some of these fees are, yeah, it's worth just asking the question, what is that and why is it there? If you have to continue paying it, then so be it. But it is very easy to refinance, which means take your mortgage off of that lender and give it to another lender who will give you a better deal. There can be fees with doing that, but often those fees will still be outweighed with the savings that you would make off of refinancing it. So, next thing is an offset account. And I'm really excited because I'm going to share my screen with you in a minute and show you especially about the interest rates. So it is going to get really cool and interesting shortly. But I just want to cover the basics. So an offset account is when you have a bank account, such as like whatever account your income goes into. And if you have savings in that account or any savings account, you can link this account to your mortgage, and whatever is in that account will be offsetting your mortgage. So for example, if you had $10,000 saved in your savings or everyday or income account, whatever it is, and you have that account linked to your mortgage, if you have $400,000 left to pay on your mortgage, but there's $10,000 over here, you will only get interest calculated on $390,000. So it's just kind of, it is a good idea. I don't mind them. It is a good way of paying less interest without having to put that money onto the loan. So it's an offset account. The reason I don't love them is because I think banks like you to do that rather than actually pay off the mortgage, because you're more likely to spend the money if it's in your everyday account. Whereas if you just pay it off your mortgage, it is done. Like, a lot of mortgages will have a redraw facility, which means that you can redraw the money out of the loan. So let's just say I put that $10,000 in savings on my home loan. If I had a redraw facility, I can take the $10,000 off and spend it however I needed to. Some of them don't have a redraw facility. So check if yours does, if you're already in a mortgage or if you're heading into one, it is worth knowing that. I definitely prefer to just put the money on it because you're less likely to spend it or pull it out. You know, it is the same as just transferring it. Mason. All right, so that's an offset account. That's what that is. And the redraw facility basically being the ability to redraw. All right, so next up is deposit. Everyone's probably heard of this, or in the States and other countries, it can be called a down payment. And that is the amount of money that you save up, typically 20% of however much your property is worth, so that you're putting forward 20% and the bank is lending you the rest. Now, if you there can be creative ways once you get further into property investing where you don't need to put that money forward, but let's just keep it basic for this video. You put 20% forward and the bank lends you the other 80%. Now, if you don't have 20%, if you only have 15% or 10%, the bank still might lend you the money. However, they will also charge you lender's mortgage insurance. This is a very bad thing. It's extra money that you have to pay back with your mortgage, and it's a huge amount and makes it very hard for you to get on top of your mortgage. You're much better to wait longer. I mean, again, check your individual situation, but in my opinion, you're better to wait longer to save the money, even if that took you an extra 2 years, because the lender's mortgage insurance might actually take you 4 years to pay back when it would have only taken you 2 years to save that money. I hope that makes sense. But typically in Australia, if you're only putting up less than 20%, they're going to charge you lender's mortgage insurance, which you want to avoid at all costs. So that's lender's mortgage insurance. And okay, so let me share my screen and we will talk about why the interest rate matters. And it matters, guys. Let me just find my spot. Screen. Oh yeah, there we go. Okay, so let's just get rid of that. Now, here's one I prepared earlier. I put the amount $450,000. Now, this is just a mortgage repayment calculator that I found online. And so we put in our loan amount, the amount that the principal amount, so the original amount that we need to lend. You put the interest rate in. So I've put 4% in, which would be high for August 2020, which is right now. The repayments can be, monthly, fortnightly, or weekly. So that's how often you are going to pay the loan back. And I think the minimum it would allow me to do was like $2,100 or something. Yeah, see, it's saying $2,149. So that's telling me that the absolute minimum that I could pay off this mortgage is about $2,200. So the loan term, if this is how much I'm paying off it, it's going to take 28 years and 9 months. Now, I bet if I put that back down to the minimum amount, which was $2,149, I think, that would probably jump up to 30 years. So the total cost of the loan, look at that, $757,000, $757,046.27. That is huge. Like, when I saw this and I started to fiddle around with this repayment number and realized how much I could change what happens over here, it just motivated me so much to get rid of the damn thing. So the total interest payable is $307,000. Like, that's like almost the same. Well, no, it's not the same. It's $150,000 difference, but that's incredible, right? Like, all right. So here, this shows us the graph. This is the total amount. You've got your principal amount, which is the amount you needed to borrow, $450. And then it shows how much interest we're paying. Now, over time, because you're paying down this principal amount, the interest also comes down. And when you get to about here, which is 17 years in, the interest becomes very small because you're really knocking over that principal amount. Now let's just play around with this. And instead of paying $2,200 a month, let's just say you only put another $100 a week, which would be $2,600 per month. That already comes down so much, like just $100 a week. What did I say? Yeah, it was $400 for the month. Sorry, $100 a week. That changes things so much. Like if you can, that's loud. Thank you. If you can afford that extra 50 or $100 a week, like just look at the difference that it makes. Now let's talk about the interest rate. So I'm just going to put this back to the 2,200 per month. Now we're at 4% interest, and what is the total interest payable? 307. Now if I change this to let's just say 3.79, which is not even, actually, just to make it easier, Christy, let's go 3.8, which is only 0.2%. Already, oh, where'd it go? Yeah, so that was 307. That's saved us like 30 grand over the course of the loan. And now let's see if you're paying, say, 3.8 and your friend says like, I'm paying 3.2. You're thinking, oh yeah, that's like, it's a bit of a difference, but I'm sure it doesn't make that much difference. Watch this. So what are we at? Total interest payable, 276. If your friend is paying 3.2, that's $75,000 difference, and changes the length if you keep paying this amount. So if you only pay the minimum, it's always going to be 30 years, if that makes sense. But if you just pay a little bit more, you can change the term of the loan. Now, what if we go crazy and we can get a good interest rate, which at the moment would be about 2.8? I'm probably being optimistic. 2.9, let's say 2.9% interest, and we paid $3,000 a month, so $800 more than what we have to, which is an extra $200 a week on this better interest rate, paying this extra money. Look at that, 15 years and 8 months. Total interest payable, $109,000. I know I'm not saying these amounts, but you're with me. That's just like, I don't know if you're looking at that thinking the same thing that I was, but this motivated me so much to just put everything that I could onto my mortgage so that I wasn't paying this ridiculous amount of interest over the course of your working life. So let's just have a look at the better interest rate with the original repayments. Like that, even that makes a huge difference. I think it was 307 at the beginning. That's 171 just because of the interest rate. So don't think that, refinancing won't be a good idea for you. It's definitely worth looking into and checking back. Oh, how do I do this? Stop share. And checking back on a yearly basis and just seeing, am I getting the best deal that I can? Because you can see there it makes the biggest difference. And I think that was the mortgage choice. Let me just check. mortgagechoice.com.au. Yeah. So that's just, obviously they're brokers. So they're going to say, we can find you a better deal, and they'll try and look for a better deal, and they get a commission off of the lender for bringing the new mortgage to them. You typically don't get charged. So it is worth doing. There's plenty of home loan comparison sites and all of that kind of thing. But the biggest message I wanted to talk about in this video was the interest rate, and that extra money that you can put on the loan. Don't refinance to a better interest rate and go back down to the minimum. Like whenever I've refinanced, they'll say, oh, now you only have to pay this much. No way. Like I always pay way more than I have to if I can. Obviously, every circumstance is different. This may not be the right time for you to be paying extra money off your mortgage, but if you have the redraw facility, then maybe that's okay. But with COVID, everyone's circumstance is different, and I completely appreciate that. And I just hope that this is helpful and informative, because I really didn't get my head around mortgages very well until years into owning property. And I wish I had, because it does make a difference. I think in your mind, you're thinking like $450,000, that's just such an obscene amount. You can't wrap your mind around how much money that is, and you kind of resign yourself to the fact that it's just going to take 30 years to pay off. It doesn't have to. It doesn't have to. And, you know, if you can benefit from just these small little changes, like the bank's not going to call you up and go, hey, so, you know, we can like save you some money. I mean, they always have an agenda. So just keep that in mind. There is no agenda to this video that I'm creating here. It's just my experience. I hope that it helps you guys. Please share it with someone. Like that does help, you know, that helps share knowledge and information. If you have more points or anything you want to add, please put it in the comments. I'd love to hear from you if you find this useful, so please do comment. I'm making these more often now, so I'm trying to do at least one a week. So if you subscribe to my channel, I think you can press a bell and it will alert you when there's a new video. So please do that, and have a great day. See ya.